Welcome everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inflation week, housing demand, and of course, putt-putt. Logan, welcome back to the podcast, and this one is live and in person. We are doing it at The Gathering. Of course, you're taking the stage tomorrow as our keynote speaker on economics. It's going to be a great talk. We've already had a day and a half of amazing content, and now we get to talk about the tracker.
Yes. Very interesting tracker this week. We always try to find if something ever switches in the data line. And of course, for myself, my own bias, inventory growing. 2024, 2025 positive. But last year, I thought we should be able to get minimum 80,000 in the new listings data. That never occurred. So for me, making that call again in 2025, I was happy to see us finally get to the new listings data around 80K, a little bit above that. But this last week, the new listings data did not have a good rebound, and the active inventory did not have a good growth. So one of the things that I'm always keeping an eye on, and last year my price forecast was incorrect because it was too low, is that we saw the data lines getting better and pricing firm up. This week, the tracker showed that the new listings data slowed down. Now, I'm hoping it's just the traditional, it maybe takes 2 weeks for the weekly data to get back to normal. But what I don't want to happen, like the number one thing I don't want housing to deal with is what we saw in the second half of 2022. That was before the tracker was even created.
That's true.
This is one of the reasons why I wanted to get it up so fast, is the new listings data was not only having its seasonal decline, it was falling noticeably. And what I see is that sellers call it quits. They go, I don't want to put my house in this market. There's the seasonal decline, but there's also the kind of the weekly decline that was already working from a very low level. And because of that, 2023 was the lowest new listings data ever. And I do not want to see the new listings data take another leg lower for the second half, just like we saw in 2022. So cautious about that data line. I'm hoping it's just the seasonal adjustments that you have to make. Sometimes it's 1, sometimes it's 2 weeks after a holiday, and we get back on track. Because 70 to 80% of home sellers are buyers. One of the reasons I believe mortgage purchase application data is up year over year is that new listings data is up year over year, and those people apply for mortgages that put their homes onto the market, so it makes kind of sense to me.
It does make sense. And this, we had a discussion about this last week about the Redfin data and how you wanted to take issue with the fact of what they were saying about sellers. And what did you think our Altos data made of that headline? Well,
I mean, to me, when you're working with a data line set that only started in 2013 and say it's the biggest sellers versus buyers, it's a stretch, considering that it was 2005 to 2007 that saw the escalation of active inventory actually take off. And in 2005 was the sales peak back during the housing bubble years. So it made sense. When I think about our Altos data, fresh weekly data, not really running on 4-week moving averages, we just see housing getting back to normal. I authentically believe post-2020, we were not in a natural state of inventory. We've never been this low ever. And if you have normal new listings data and demand is somewhat suppressed, you should get back to 2019 inventory. You asked me the question about when will I ever get concerned about inventory growth? I actually look at it, I'll get concerned about the housing market if I saw new listings data start to accelerate, because that to me is not the traditional seller that is buyer. We saw that during the housing bubble crash years. Even though inventory wasn't really growing, the new listings data was running at 250 to 400,000 per week. Those were distressed sellers that were not going to be buyers, and that was a chunk of the demand curve back then.
Okay, so explain that a little bit, because I think it's always confusing to me, but you've explained it to me several times. Explain it to our audiences, like new listings and inventory. How do you say new listings is not inventory?
Okay, so the active inventory can grow. The new listings data are the homes that come onto the market that do not have a contract. It's very seasonal. Usually it's between 80 to 110,000 during the seasonal peak weeks. but it doesn't fully go in because those homes could go into contract, right?
Okay.
And active inventory can still grow. We've had active inventory grow in the second half of the year a little bit much more differently than we saw in the previous decade, or we've seen the seasonal. We did this podcast a few years ago where we talked about it takes a little bit longer to get the seasonal bottom. But if you're in a normal year, the seasonal bottom should be February, you get inventory growth and then the seasonal decline. But when you see new listings data take off like it did during the housing, you got to say, okay, why are these people listed? Oh, the short sales, foreclosures, distressed sellers, right? We have never seen any of that in the last 5 years. That's why when people are thinking we're going to have massive distressed sellers into the marketplace, hasn't been the case. However, you want normal new listings. You want that. Usually it's between 80 to 100,000, but I like to use the 110 level just because we've had some weeks in the past decade there. So healthy, I just don't want it to regress back, right? I don't want new listings data to be stuck in the 70s and all of a sudden now it's on par with last year or even goes lower. Normal new listings is healthy. A normal active inventory market, 2019, very healthy marketplace in terms of active. It keeps the buyer-seller profile in balance, where the buyers had way too much power after 2020. That was the whole concept of team higher rates. So I'm just hoping that next week the new listings data just gets back, and sometimes it takes 2 weeks to work off of weekend data.
So you've said that the normal or healthy new listings data is like 80,000 to 110,000 when it's seasonal peak of home
seasonal
buying.
peak period.
And last year you got 0 of those weeks. This year you have had what, 2 weeks?
2 weeks above 80. I'll take the victory. I mean, I prefer it to range between 80 to 100,000 for many weeks. This is why I was slightly concerned about what happened last week. But when you read the tracker, you can see our pending sales data, the seasonal demand curve. Now we see the fall in that. The weekly pending sales data, we see it very seasonal. Just remember that because the bar is very low, over the next 6 to 7 months, especially from July to November, the reports from June to October, even if home sales stay flat, you're going to show year-over-year growth. If you pick up on the sales demand curve a little bit more, then the growth will be a little bit higher. But we're working from such a low bar, but because purchase application data is positive, right? Because new home sales purchase applications post-COVID high, the demand curve is better this year than we saw last year.
I think the thing I really appreciate about the tracker is that you're tracking these things every week very religiously, and you put your spin on it in the sense of like, hey, you emphasize one part of it, but like you're not a perma anything. So like when you're excited that we have more new listings, but you're like, still, we're working from a very low bar. We're just getting back to normal, right? You're not trying to be like the anti whatever, like you're not trying to be like, everything's great in housing. I mean, you're just trying to go to the data.
It's funny. As somebody who said the housing market was unhealthy at the end of 2020, who was very unhealthy in 2021 and was savagely unhealthy, the way I look at economics is a little bit different. Of course, sales were much higher, but because we lost balance, that wasn't good. Last year, I'm like, yes, inventory's up. We're starting to get balance. In the long run, that's what you want. That's what you need. So of course, I look at it different. I know a lot of people say, why are you so happy even though sales are low? I said, I'm getting what I need because when I look at all the economic cycles in the last few decades, this has to happen for sales to really grow in the future, and it's happening. And it's not shocking to me that even with elevated rates, purchase application data is acting better. But my God, if rates were just down to 6 and just stayed there, sales demand could grow. Because if you're getting growth in purchase apps, cash buyers are a little bit lower this year. To have that happen with rates basically 6.8 to 7.10 for majority of the time, that just shows you that wages are growing, households are forming, selling equity is there. All these things we're trying to get back to normal. And if you just get 1 million more home buyers, basically that's the peak total sale levels of what we saw in the last decade 2010 to 2019. It took a while to kind of get up there. It's toward the end of the decade that we had that. But here, man, it is a positive for this year. And I know a lot of people say, well, sales are down. Yes, but unlike before, inventory is growing, price growth is killing. If prices were up 6% this year, I'm not having this conversation. Why? Because that's what happened in 2023. New listings data hit the lowest levels ever. Inventory didn't really grow until toward the second half of the year, and that's a little bit too late for the calendar year.
Those of you who read the tracker regularly know that at the very bottom of the story, at the end of the story, Logan, you always say, here's what to expect about this coming week. And it's amazing how often these things come around. Last week was jobs week. We got a lot of good data there. This week is inflation week. So what do you expect to happen?
So for the next 7 months, we're going to enter kind of a new phase of this economic cycle. Either the tariffs are going to be inflationary to some people's forecast. The last PCE inflation headline print, 12 months, was running at 2.1%. That's near the 2% Fed, but the Fed likes to look at averages. So over the next 7 months, if the inflation is going to happen, you'll see it in the data. There's already people forecasting 3 to 4%. It's nothing like what we saw in COVID, but that makes the Fed's job a little bit more interesting because even though they're talking about we're just waiting to see, a one-time price off, but if inflation picks up and the labor data gets softer, look for the shadow Fed president to kind of get more into the discussion. Again, I still believe if the labor data is getting weaker, the Fed will be a little bit more dovish, might not be as dovish as some people want. But we're starting to get to the part where, over the next 6-7 months, that's how you should look at it. It's either going to happen there or it's not going to happen at all. So the first few months of the year, we just simply, the tariffs didn't take into place. And we're talking about Godzilla tariffs here. We're not talking about what we saw in 2018. The growth rate of inflation was actually falling in 2018-19. It's a much different backdrop. So we'll get to see. And then again, if trade deals are done, whole different story, right? Because the Federal Reserve has already talked about, hey, listen, if we get deals and if this thing ends, we could be a little bit more dovish because they have a little bit more clarity in the future. So we'll talk about the inflation report itself by the time we do our next podcast. But start to get your mindset geared up that, over the next 6 to 7 months, if it does happen, it'll start showing up in the data. On the CPI side, just remember, rent is the biggest factor there. The growth rate of shelter inflation is falling, not fast enough for some people. The PCE inflation, where the Fed really tracks, that's the one that will be a little bit more interesting. But think about it not just for this week's report, but over the next 6 to 7 months. And then, what happens with the Federal Reserve and what happens to the labor market. It becomes a very interesting triangle dynamics now going out for the rest of the year.
So it feels like the recession talk has faded a little bit.
I think if everyone was kind of in the recession camp because they thought if Godzilla tariffs stayed in right. We weren't getting stuff. We weren't getting stuff shipped. So people were thinking, okay, we're going to shortages again, except shortages with rates at elevated levels. A lot of people went into the recession camp. Of course, tariff deals were talked about, pauses, stuff like that. So a lot of recession talk, but we always have to remember, we keep forward with our economic cycle models, right? And so far the residential construction workers haven't lost, but like we talked about on Friday, for the first time in many years, the labor data is slightly underperforming. So we'll see. There's just a lot of moving variables that aren't so dynamically structured to fit into the data lines each month. So we keep a track on the weeklies to see what happened. And again, the consumption data, even the weekly consumption data that we like to track on our own is still holding up. So if that keeps on going, you could prevent definitely a recession in 2025.
We talked a lot about in the last couple of months, like the soft data versus the hard data, but it feels like the soft data may be like the sentiment surveys or things like that. It just never really translated.
Sentiment data hasn't been the best the last few years, and as you can imagine, very politically ideological lately. If you took it at face value, it's the worst time in recent history in economics. But again, once some discussion on Godzilla tariff easing, stock market rallied, very good for the spreads, right? There's not a lot of mortgage volatility, even on days when the 10-year yield is up. So there's things that we want to focus on the economic side. It just gets a little bit more complicated going out because now we'll see some of the tariff impacts hit the data lines. It's frustrating for a lot of people because they can't really see it yet, and we're gonna start getting some of the data. But a positive that Godzilla tariffs did not stand because I think the sentiment was so bearish. When people see the stock market in a bear market, they see bond yields rising, they see tariffs, and not the best backdrop for the economy. And now things have changed. Now they're talking about more deals.
More deals, but also we have some things that are like they've been put off 90 days, they've been put off until a certain date. So it's still hard to say like what's going to happen there.
Who knows, right? Is there ever going to be a deal? Again, my back of the mind thinking is that Trump wouldn't really do the shadow Fed president if deals were made and the Fed was thinking, okay, this is good enough. So just keep that in mind going out in the future until we actually see the deals, right? We haven't seen anything yet, really, nothing in grand scale. And then we can move off of that. But until it happens, got to verify it, got to see those deals in writing, got to see what it implies. And then, of course, there's a lot of discussion on the budget, the tax bill, and everything. And how many days has it been since Moody's downgraded the U.S., and the 10-year yield is still roughly in the range? Remember, if the economy is expanding 4.35 to 4.70, the upper range for 2025, perfectly acceptable where Fed fund policy is right now.
So when you first started writing for HousingWire, your big thing was demographics between the years 2020 to 2024. I don't know how many, that phrase, the demographics between the years of, because you saw this giant patch of millennials coming into their home buying age, and you're like, they're going to hit peak home buying age during those years. And then, of course, we had COVID come. We had, everything kind of got jumbled up. When you look, now we're in 2025, right? What do you think? We're seeing that little demand. That's what you're saying. It's not overwhelming. But what do you think from a demographic perspective? I'm always trying to get your next thing.
So because home sales are so low, I always say we're missing, as long as sales trend around 4 million every single year, we're missing about 1.3 to 1.7 million home buyers in there. So if 2025 hangs around this level, we're close to that 4 million. Because sales are so depressed, I had to adjust my outlook going out for 2025. I wasn't going to do anything. 2024, I was going to be done, and that was it, and go on. But because of that, we're working from such low levels that we have to, kind of matriculate the data, thinking, okay, from a very low bar, we kind of work ourselves up. And again, if you guys look at existing home sales, going back to 1968, sales tend to fall down, stall for a few years, and then rise for many years. Even in the 80s, after the housing bubble crash, a lot of cycles like that. Because sales are so low, and we have 5 generations, Gen Z is buying, millennials are buying, Gen X, baby boomers, even the silent generation. Then you take investors and cash buyers. That whole buyer profile is still there, but we're just working from very low levels. So I like to put the growth in sales in context to working from extreme levels, rather than saying, well, years 2020 to 2024 is the only time that I think total sales could get above 6.2 million. We did that for that period of time. We couldn't do that in the last decade. Now we're working from such low levels. You adjust to the economic cycle itself.
So are you saying that there is, we're short 1 million buyers per year of that thing, or right now total?
Per year. If we just get back to the peak of the last decade, total home sales should be near 6 million. That's just going off the last decade. Every year that we're at these low levels, the normal demand curve has just been taken out. So because the bar is so low, we have to adjust it and not make too much of sales growing from these levels. In the last decade, I didn't believe total home sales, new and existing, could ever get above 6.2 million. We didn't have the demographics back then. But for this 5-year period, we should, but home prices escalate. Everything that I hope wouldn't happen, happened, right? Prices escalated out of control, rates never got high enough, quick enough, and home sales got hit, and now we're sitting here. But because the bar is so low, obviously everyone can see home sales aren't crashing anymore, but they're stuck here at this level. And it is encouraging to see that purchase application data has been positive this year, even with elevated rates.
Thanks for explaining all that. Okay, so I could not leave this episode alone without just asking you very sincerely, Logan, are you going to be playing putt-putt today?
No. I'm not going to play putt-putt. I'm not going to play pickleball. Y'all get a basketball court going, and then we'll all go up there and play ball.
But you notice it's called putt-putt golf, and everybody here knew what that meant, and nobody
because you're all trolling me. Okay, so I gave you the victory. So
Listen.
now we're all going to go and force Sarah Wheeler to put me on 4 times a week, right?
This is our newest fight, and I will tell you, we were at a really big party last night that we were hosting, and I had multiple people come up to me and be like, Logan really does need to be on 4 times a week. I was like, did Logan put you up to that? Some of them, they were like, no, and it seemed like you had a conversation, but some of them were like, no, I need this information 4 times a week. So
Sarah Wheeler at hwmedia.com. Send her all the emails. If you see her in social media, just send it,
Okay.
Comment on the YouTube section 4 times. I eventually want to get to 5 times a week. It's going to be a 24/7 eventually, Logan all the time. It's
he
going to be
wants it
great.
to be like Logan TV. That's what he really wants. He wants it to be like the Truman Show, only it's just like follows Logan around while he looks at charts on Friday night, and then he checks the 10-year yield in the middle of the night. And
if you're going to have a nerd in America, might as well be me, right? It'll be somewhat entertaining.
And actually, my email address is sarah@hwmedia.com. So there you go. Let me know what you think. I am very interested. And Logan, as always, thanks for being on.
Pleasure to be here.